Hello, this is Julius from Basic Financials. This video is going to be about double entry bookkeeping. Oh no, everybody says. Double entry bookkeeping. I think double entry is brilliant. Now that might be a bit sad, but it's been around for a long time. And I think it's double entry, so there's two sides to everything. And I think it's just so logical, and it can answer so many questions, and it's simple. There's only two things going on every time. It could be that you've got an awful lot of things going on, but you can break that down into just two transactions each time, going one from somewhere to somewhere else. And if you just keep breaking it down, just the two transactions, then you can always find the answer. So I just think it's brilliant. Anyway, there's a little bit of background on it. Debits and credits, that's what double entry bookkeeping is all about. Now, I like to think of debits as going to somewhere and credits as coming from somewhere. And every transaction, as I say, has two sides to it, a debit and a credit. So everything has to balance all the time. The debits will always add up to the credits. The total of the debit column will always add up to the total of the credits column, because you have two sides every time. Now, the other way of thinking about debits and credits, a debit entry is either going to be an asset or an expense, and a credit entry will either be a liability or income. Now, that's four terms there. So you've got assets, expense, liabilities, and income. Now, the assets and liabilities are what forms part of your balance sheet. So that's an accounting term. So a balance sheet, that's basically it's a list of all of your assets and liabilities. So, for example, the money you've got in your bank, the equipment that you might have, for example, motor vehicles, or stock of goods, amount of money that people owe you. So those are all your assets. Then your liabilities are maybe your bank loans, hire purchase accounts, what you owe people, what you owe the tax man, and then your net assets is what basically the company is worth. Now, on the other hand, so that those assets and liabilities are ongoing. You don't do it for a period and then stop. There's always going to be an asset there and a liability there. Just because you get to the end of a year doesn't mean, that's the end of it. It stays there and carries on. So that's the difference between a balance sheet and the other bit, which is your profit and loss account. The profit and loss account is what deals with the income and the expenses. Now, that is for a period. The profit and loss account will be for a period. So normally a year. And at the end of the year, it wipes down to zero, and you start again for another year. So that's where it changes from a balance sheet. And when I say it wipes down, you'll have a profit or a loss for the year, and that profit for the year will go to another place on your balance sheet, which shows the accumulated profits and losses since you ever started. So that becomes a part of your balance sheet. And your assets minus your liabilities will be equal the accumulation of your profits and losses. So that's rough as a guide to what a balance sheet and a profit and loss account is. Now, a previous video I mentioned about debits and credits and how it can get a bit confusing with when you think about your bank accounts, because very often people will think of a debit balance on your bank as being overdrawn, but in fact you've actually got money in your bank. Well, as I said, a debit is an asset. So if you've got a debit balance on your bank, you've got an asset, which means you've got money in your bank. And it gets confusing sometimes because the banks show it from their point of view. So they're telling you what their records show. So if you've got an asset, from their point of view, that's a credit balance because they owe you that money. It's a liability. They owe you that money. It's your money, not theirs. So that's why sometimes there's confusion between debits and credits, especially when looking at bank statements. Now, but very straightforward. I'm just going to do a little work through to show you how debits and credits might work and how it relates to the balance sheet and the profit and loss account. You might want to write it down on a piece of paper as I'm saying it. I'm not going to do so because I won't be able to see it very well. So I will just do it slowly and you try and write it down as I go. Now let's say, for example, and also I'm going to keep it simple, so I'm not going to, nobody's going to be giving credit and you're not going to be giving credit to anybody. So everything's done on cash or through the bank, in other words. We'll say it's just a bank. But there's no, people aren't going to say, well, you can pay me in a month's time, and you're not going to say you can pay me in a month's time. Everything happens instantly, just to make things simple. So let's say you've got a bank account and you sell, let's say you sell golf balls. And you sell £10,000 worth of golf balls and somebody pays you for that. Now, remember the debit and the credit, two sides to everything. So that £10,000, where's it come from? It's come from sales. So you're going to credit sales, and where's it going to? It's going to your bank account. So you're going to debit your bank account. So at that point, there's a bit of a question there, where did those golf balls come from in the first place, but ignore that just for the moment. That simple transaction, you've now got a profit and loss account and a balance sheet. Your profit and loss account shows income, sales, £10,000 of golf balls. So at the moment you show a profit of £10,000. And on your balance sheet you have got money in your bank, £10,000. So your balance sheet is an asset of money in your bank, £10,000, which is represented by the profit and loss for the year, which is £10,000. And then your profit and loss account shows the detail of that profit or loss for the year, and that at the moment is just a simple income, £10,000, no expenses. Therefore you've got a profit of £10,000. Now, let's say, this probably should have happened first, but let's say you go out and buy, you actually pay for those golf balls that you had in your stock. So let's say you spend £5,000 on golf balls. Should have done it the other way around, as I say. You spend £5,000 on golf balls to enable you to have made that £10,000 sale. Now, it's coming out of the bank this time. So you got £5,000 being credited from your bank account. Remember, it's the other way around from the bank, so don't get confused about that credit. It's coming out of your bank. It's being credited out of your bank, coming from the bank, and it's going to purchases, i.e. purchases of golf balls. So at this point, you've now got your profit and loss account. You've got that £10,000 sales from before, and you've got £5,000 purchases, which gives you a net profit of £5,000. Your bank account, it did have £10,000 in, but now it's just taken £5,000 out, so it's only got £5,000 in there now. So your bank account now shows £5,000. That's your balance sheet. It's got an asset of £5,000, and that's represented by your profit for the year, which is £5,000. And the profit and loss account shows the detail of that, which is income for £10,000 minus purchases of £5,000, which gives you £5,000 profit. Now let's do something a little bit different. You need a piece of equipment for maybe putting a logo on your golf balls, that's for example. So you go out and spend £1,000 on a fixed asset, a piece of equipment. Now that is, we'll call that plant and machinery. So the money's coming from your bank account, it's coming out of your bank, so you're crediting your bank account, and you're going to debit, it's going to fixed assets. So you've got £1,000 in fixed assets. So that doesn't affect your profit and loss account at that point, because that piece of equipment is what you call a fixed asset. It's an asset. It's going to stay in you're going to use it for a while, probably more than 2 years, for example. So your balance sheet now will show fixed assets, plant and machinery, 1,000 on the debit side. It will show money in your bank of now £4,000, because you had the 10,000 come in, 5,000 for purchase of golf balls, and you've just bought a piece of equipment for £1,000. So you've got 4,000 left in there. So you've still got net assets of £5,000, the 1,000 plant and 4,000 in your bank. Your profit and loss account hasn't changed. You've still got the 10,000 income and the 5,000 purchases, giving a 5,000 profit. So your balance sheet still balances. You've got net assets of 5,000 still. It's just slightly not all in the bank. You've got a fixed asset and some money in the bank, and it's represented by that profit and loss account. I think you can probably start to get an idea of how it's building up there with these debits and credits. But the fact that there's two sides to everything means that the balance sheet will always balance. You can always double check to make sure things are going okay, and it's just an amazing system. And all of the accounting software that you get, although they try to make it so that you don't need to worry about what debits and credits are, it's all working on that in the background. If you can understand what's going on in the background, then it makes it much easier to sort out if there's any issues. And if you understand what's a debit and what's a credit, and why something's on the left and why something's on the right, the left is normally a debit balance and the right is a credit balance, then you will be able to work out if there's any issues, anything going wrong, and understand things a bit better. I might, that left and the right hand side, I might do another video on it sometime, but basically that stems from the debits and credits. They're called T accounts. So if you imagine a big T, and the debits will go on the left hand side and the credits will go on the right hand side, and these T accounts, they used to be ledgers. So in the old days, and this is what the accounting software does as well, but in the old days you'd have a ledger with all different accounts. So you'd have had plant and machinery account, you'd have had a bank account, you'd have had a sales account and a purchases account, and there'd be T accounts. The debits would go on the left hand side and the credits would go on the right hand side, and every time something happens you would put that entry in, and then you would be able to find out what for the balance sheet. So the bank would always have a balance on it, and the sales, you would be able to see what the sales are for a period, but it would all be manual. Whereas now it's all done on the computer, which is great because you don't have to keep adding it up and carrying forward balances. You can just, it will add it up automatically, and you can pull out reports from the system which will give you a picture of where you are at any particular time. So that's brilliant. But it's all working on exactly the same principle: debits and credits, double entry, and it's I suppose it's what computers do, isn't it? It's like binary code. It's ins and outs and pluses and minuses. It's all everything's two stages. So that's why I think it's brilliant. Anyway, I hope you enjoyed that as much as I did. Thank you for listening, and I'll speak to you again soon. Don't forget to like and subscribe and give me any suggestions or questions. Thank you.